Despite Canada's annual inflation rate rising more than expected in September, my next guest suggests that the Bank of Canada will overlook the inflation surprise as the economy remains weak. Let's welcome Randall Bartlett, Deputy Chief Economist at Desjardins. Randall, thanks as always for joining us.
Oh, thanks so much for having me.
You remain optimistic. Why is that?
Well, it's our sense that when we parse the inflation data, that while there was a pickup in inflation in September, a lot of that relates to actually what happened last September, where we had a sharp month-over-month decline in inflation. And actually, when we look at the actual advance of inflation, it's not nearly as strong as would be suggested by the headline year-over-year number. And ultimately, that's going to come out in the wash pretty quickly. So once we get into October, November, December, we're expecting inflation average around 2% in that last quarter of the year. And so we think the Bank of Canada is probably going to fade this increase that we saw in September as sort of a one-off, and is going to look to actually what's happening in the Canadian economy, where growth continues to be weak, the labor market is soft, and its own surveys that came out just yesterday pointed to expectations for continued weakness in the Canadian economy.
And what sectors did you look at that you liked the numbers you saw with it, and what were the ones that maybe were a little worrisome for you that may play down the road?
Yeah, I mean, our sense is that we're still seeing the retaliatory tariffs feed through into overall inflation, and that's going to continue to sort of come out in the wash, as we saw that the federal government eliminated many of the retaliatory tariffs as of September 1st. And so it takes time for that to feed through into the numbers, but that's going to provide ongoing support to lower inflation and less inflationary pressures than we would have had otherwise. So the sectors that are primarily going to benefit from that really are things like food prices, other consumer goods that were impacted by tariffs, services not as much, but certainly on the good side of things, we're expecting to see that a lot of consumer items are going to be positive, are going to benefit from lower overall price pressure coming from tariffs.
And what about the other side? Any sectors that raise some red flags for you?
Yeah, I would say that services inflation continues to remain higher than I think the Bank of Canada would like to see it. Part of that reflects the fact that wage growth has continued to be solid in Canada for a few reasons. I mean, part of which is ongoing labor negotiations that are helping to support solid wage growth, but also what we're seeing at the bottom end of the income distribution with increases in minimum wage throughout the pandemic that are ultimately continuing to support solid wage growth at that part of the earning spectrum as well. And so overall, that still solid pace of wage growth, well in excess of inflation, has certainly supported ongoing services inflation as well. But we are starting to see that track lower to some extent. And so that is something we're going to be watching going forward.
And how is the Bank of Canada, do you think, weighing that wage growth?
Well, we think the bank is, quite frankly, is going to be looking past it. Obviously, the labor market has been weak in Canada, not as bad as we would have expected, given the sharp drop in GDP growth in the second quarter, as well as the headwind we're seeing in the economy from the Trump tariffs. But ultimately, the unemployment rate is above 7%. We think the sort of rate of the unemployment rate when the economy is operating its potential is probably closer to between 6 and 6.5%. And so the economy is weaker. Ultimately, that should lead to mitigating downward pressure on wages going forward. So we'll see how it plays out. But we think the Bank of Canada is going to keep an eye to that, but is looking more toward where the unemployment rate is and the risk of additional potential job losses going forward.
And will the BOC, its survey yesterday came out that showed about 2/3 of consumers think Canada may be entering a recession in the next 12 months. What kind of a factor will that be? Or how are they taking that into account?
Well, I think that's something that certainly is going to give the Bank of Canada a little bit of pause, in that we think it'll offset the weight that'll be put on the most recent inflation print. If Canadians believe that the economy is going to be going to recession by a 2-to-1 margin, essentially Canadians will be more likely to reduce consumption, set savings aside for a rainy day, and that ultimately means that it'll slow economic growth and slow employment growth. And so the Bank of Canada can get ahead of that, by providing a little bit more support to the Canadian economy by reducing interest rates a little bit further going forward.
And then two government notes here. Prime Minister Carney, we've heard reports that there might be a trade deal with the U.S. and also the federal budget's coming up. How are they going to weigh in on the Bank of Canada?
Well, certainly, if there is some sort of trade deal with the U.S., we could see that the Canadian economy could track closer to the Bank of Canada's de-escalation scenario that it published back with its July monetary policy report, which was very much its most optimistic scenario. So we could see a greater tailwind to economic activity in Canada if the trade deal is one which is going to put Canada in a better position than it's in right now. And Canada, relatively speaking, is actually in a pretty good position from a tariff perspective, just given the fact that we've had exemptions for USMCA compliant goods, and so many goods have become USMCA compliant since the beginning of this year. And so hopefully it will provide even more support to the Canadian economy. On the budget side, we're expecting a substantial increase in spending. That's what the federal government's telegraphed. Defense being a big part of that, but also infrastructure and other spending. And so our sense is that ultimately that's going to provide a tailwind to the Canadian economy as well. And so those pieces together should not only support growth, but probably to some extent, support job gains and also be somewhat inflationary as well. And so ultimately that should support, we think, the Bank of Canada after another cut, maybe two, staying on hold for some time until it starts normalizing interest rates again, starting at the end of next year.
All right, Randall, thank you as always for your input. We appreciate it, your expertise.
No, my pleasure. Thanks for having me.
Randall Bartlett is Deputy Chief Economist at Desjardins.